the Fed's monetary policy really driving the dollar's decline? Well, let's ask our next guest. He's European Head of Global Foreign Exchange Research at Bank of Tokyo-Mitsubishi Ltd, and he is Derek Halpenny. Derek, thanks for coming in. Well, that's the question, isn't it? Is the Fed's policies at the moment really contriving to weaken the greenback?
Yeah, it's a key catalyst, and it's not just the actual stance, but it's the message that the Fed is sending to the market, and in particular the wording in terms of the extended period. And that's why tonight will be interesting, because we have the minutes of the FOMC meeting where they interestingly put some conditions on maintaining that wording in terms of extended period. Two of the conditions are quite normal: capacity utilization and inflation, but the third was inflation expectations. And there's an explicit linkage there which wasn't there in the past, and that, I think, is a potential for the Fed to respond in a more leading manner than they have done in the past. And it'll be interesting to see if there's a particular reason for putting that in, and if it is that would certainly be an indication that they are aware that in the past they've been slow in terms of hiking when they've been looking at lagging indicators. The
danger is that if you keep on saying we're going to have rates at these lows for a period of time, a significant period of time, and there's no exit strategy in sight, that you end up in a position where you create even more uncertainty, and you perhaps people have the spectre of inflation staring them in the face.
Well, yeah, you know, when you look at what the Fed are doing, it's unprecedented, and it's understandable that the markets are focusing at the inflation risks. But, you know, an inflation problem is a very long way off, in my opinion. And the story for next year, I think, is going to be good growth from the United States, in particular from the corporate sector after very strong corporate earnings. And that in itself is going to be coupled with falling inflationary pressures. So I think, you know, the idea of inflation being a problem, I think, is a problem really that potentially could come 2011, probably 2012.
Right, with that in mind, how vulnerable is the dollar then?
Well, I think short term it's still vulnerable, because that's the message that the Fed is giving. And I think, you know, from Trichet's comments there, I think all the global authorities are very aware of the potential risks of a notable slide in the dollar, and I think they're all very much against that. I would argue, though, that what's priced in the euro curve, for example, in terms of monetary tightening in 2010, is becoming excessive. You know, the 3-month LIBOR implied at the end of next year is just under 2%, and to me that's assuming more monetary action that we're actually going to get from the ECB. And once the markets start to realize that the ECB are going to be very, very slow in raising interest rates also, that's likely to temper the enthusiasm for the euro.
We're having a real problem, though, with the dollar and the euro at the moment. 150 is a level which is key, and it's a real problem actually going above that, isn't it?
It is. You know, it's such a risk trade. You know, the correlation with the S&P is extremely strong, and we are getting into a situation, I think, where the momentum in the equity market is beginning to fade. And I think if we approach year end, there is that potential, I think, for investors to liquidate and take profit in what has been obviously very difficult market conditions. And if that is the scenario as we move into December, that will be an important supportive factor for the dollar.
Derek, thank you so much for coming in. Derek Halpenny there from Bank of Tokyo-Mitsubishi UFJ.